So today we're here to foresee your future, because at first you did your stock research and found an amazing company. You kind of fell in love with their business model, their metrics, their fundamentals, and where the company's going. You like their growth vector. Unfortunately, you can't sleep at night. You're worried. You feel that you would be paying too much right now. Shares are overvalued, and you fear that the bear market would crash your investment if you don't buy at the right price. So today, together, we'll foresee the future. We'll use the dividend discount model and determine how much you should pay for the stock you fell in love with. Let's do this. Dividend investor, bonjour. This is Mike Roux, founder of Dividend Stocks Rocks and passionate investor. Welcome to today's topic. We're tackling a very boring yet important topic today. We're talking stock valuation. I don't know if it's your first video about the dividend discount model, but most of what I've watched on YouTube goes like this.
Well, you are going to receive a dividend payment of $2.
Like, seriously, you're going to watch a 15 minutes video telling you about the formula and all the academic stories done behind it, but at the end of that video, would you really know how to use it? Would you be very able to just know the stock price you should pay for any companies that is on your watch list? I don't think so. So we're doing things a little bit different today. I want to show you in the real life how I use the DDM model to make smart investment decision. But first, let's go to the basic. So the dividend discount model is one model among a bunch of stock valuation calculators. This one is looking at any stocks such as a money printing machine. So picture this, you go in a store and you want to buy a money printing machine. How cool is that? So you have the choice between all kind of different machines, and the price you're going to pay is in line with how much money that machine will print in the future. So basically, the dividend discount model tells you the value today of your future dividend payments. So it will discount, as we like to say in finance, the value of all those future payments. So let's say you want to buy shares of RBC, for example, Royal Bank, which is the largest Canadian bank, and you want to know how much you should be paying. So you can estimate how much money you're going to receive in dividend for the next 20, 30, 40 years and discount all those money as today. So basically, you're just giving him a value of that money-making machine. So now you understand that the dividend discount model is giving you only the value of the future dividend paycheck you're going to receive. You can actually use it for a good purpose. The reason why I like the DDM so much is first, it's very simple. You only have a few set of metrics to enter in a calculator, and then you get the value right up front. Then that information is quite easy to get, and we'll get that in a second in a real life example, but basically it doesn't take hours to figure out how to use the DDM model. And finally, it's a good start for your investing process. I'll tell you up front, I never trigger a buy or a sell transaction based on valuation. I don't think it's worth it. I don't think it works that way. And honestly, this is only a tiny part of my investment process. Yet, it is quite important to understand how it works. So now, let's see what you need to use the dividend discount model. But first, let's take a coffee break. Oh, that was nice. So basically, if you want to use the DDM model, you only need three metrics. The The first one is the dividend paid. And make sure that you select the annual dividend paid. Some companies are paying their dividend on a quarterly basis, others on a monthly basis, and some, very few, will do it twice a year or once a year. So you want to make sure that you go on a free financial website such as Yahoo Finance or the TMX if you're Canadian, and you pull out the annual dividend payment. Then number two, what you need is the dividend growth rate. So basically, this is your assumption, your best bet on how the company will increase its dividend going forward. You can use the 5-year dividend growth rate, the past 3 years, and last year as well to set up a trend and see where the company is going with their dividend growth policy. Make sure that you take a look at revenue and earnings growth also, because if you're not making money, you're not making profit. And if you're not making profit, you won't increase your dividend, right? And lastly, payout ratios. But those are topics that I will be covering in other videos. But at this point, this is the tools that you will need to determine your dividend growth in the next future. I personally use a 2-level dividend discount model. This means that I use a first dividend growth rate for the first 10 years. So it's very close to what's happening right now at the company, because this is a lot easier to understand. And then a second one, which will be more like a long-term dividend growth rate. So I will always use it a little bit smaller to be more conservative. And number three, what you need is the discount rate. Now, the discount rate is also called the expected rate of return. In other words, is if you're about to put $10,000 to buy specific shares, you want to have a return on your investment. And that return can be determined by either you or the market. Financial theory tells you to use the capital assets pricing model. It's a big word to use, CAPM, right? The CAPM works with lots of academic studies. We're talking about the beta there, the risk-free return, and then the premium that you should get because you're taking a risk, and all those like great calculation done by PhDs. But honestly, I don't use that. I use a simple system with 3 different expected rate of return. So I have 9, 10, or 11%. Quite easy, and I categorize companies in those 3 buckets. Basically, bucket number 1, at 9%, you have an amazing leader. You have a company that shows low payout ratios, strong dividend growth, and most importantly, a stable and predictable business. So those companies, those gym, those like stellar enterprises deserve to have a lower discount rate, because you know that your money is a little bit safer when you invest with them. Then when those kind of great companies shows a few flaws or their environment tends to evolve very quickly, then I will use a 10% discount rate. So that's the second bucket. So the second bucket is all about good companies, but could go wrong at one point in time. Best example I could think of is Apple. Apple is a great company generating lots of cash flow and being quite generous with their buyback programs and dividend growth rate recently. However, we all know how fast technology evolves, and you don't want to get to buy the next BlackBerry, right? So you want to make sure that Apple's doing the right thing, and this is why I'm asking a little bit more on my investment than I would use for the first bucket. And finally, the third bucket, in my opinion, I'm not too sure I would buy a lot of stocks there, but from time to time, if you want to get something a little bit more riskier, that you're looking to get a little bit more return on your investment, or you're catching a falling knife, for example, so a stock that is just like dropping like crazy with a high yield now, and you're thinking, oh, the market doesn't know what they're talking about. I do. So those kind of companies, use the 11% discount rate, the third bucket. So I might be thinking of companies in the energy sector, for example, as several, not all, but several of them, their business model is highly dependent on the oil market. So commodity prices. The oil barrel goes down to 45 bucks. Most of them will have to cut their dividend. And this includes additional risk. And this is why you should use the third bucket for those. Now, all of this is quite interesting, but it doesn't tell you how to really interpret financial metrics and use the dividend model to make smart decisions, right? So let's go back to this computer and we'll do some math now. So now what you have on your screen is basically a dividend discount model template that I've developed for my DSR members. As I mentioned before, I'm using a 2-level dividend discount model calculator, so we're going to put our attention right here. Basically, as I mentioned, you need 3 things to use the DDM. So the dividend paid, the expected dividend growth, and the discounted rate. The main difference with the 2-level DDM is that you will have a first dividend growth rate for the first 10 years, which will be very close to what's happening right now with the company. And then you will have a terminal dividend growth rate. So that is for basically getting paid forever. So usually we will use a smaller amount right there. I decided to use Royal Bank as my example right here because I want to just say a little hello to all my fellow Canadian investors. If you want to get the information, one of the great places you can get it for free is on the TMX. So basically the TMX is getting all the stock quotes and stock information for all Canadian stocks. If you're American and you're watching this video, you can get similar information from Yahoo Finance, Google Finance, or even Seeking Alpha. So let's type it in. So we're looking for Royal Bank right here. This is what we need. And we want to know what is the dividend paid. So first information, we're going to get it right under the graph right there. So let's pull down a little bit. So you can see that the dividend paid is $1.05. Super important, as I mentioned before, this one is paid quarterly. Basically, what you need to do then is to multiply $1.05 by 4. So going back to our metrics, right there, we're going to put that formula right here. So $1.05 times 4. The annual payment is $4.20. Now comes the hard part. You need to determine what is the expected dividend growth rate. I've picked RBC because it's an easy one. The stock over the past 10 years have increased its dividend by 7.7%. Over the past 5 years, we're at 6.96%. And last year alone, they did 2 dividend increase in the past 12 months. We're talking about 7.14%. Basically, what I can do here is to put 7% for the first one, and if I want to be a little bit more conservative going forward, just expecting 7% dividend increase is maybe a little bit generous. So let's put 6 to see how it goes. As you can see, we don't really have information right there because we haven't entered a discount rate. Now, following my simple rule, I decide that I'm going to use a discount rate of 9%. Because RBC is a well-established leader in its business. They're part of an oligopoly managed by the federal government, little competition, great profit, great growth vectors going forward. And you can also look at the payout ratio. We're talking for RBC and most Canadian banks, payout ratios between 45 to 50% from time to time. So I think that a 9% discount rate would be something that makes sense. Now, as you can see, right now you have intrinsic value for a discount rate of 9%, which should be $161. Now back to the TMX a second, because I don't think I've seen that. See, right now at the time of doing this video, August 23rd, 2019, we have basically a price between $99 and $99.50. So we're definitely way ahead with our valuation model. Does it mean that you should buy it at $100 basically, and within 12 months you're gonna make $60 out of it? Like, it's a 60% return and slightly over that. This is like a huge discount on the current price, right? Well, this is where it gets tricky. This calculation is only good if RBC starting today and then forever down the road will print money the way it does right now, paying a 7% dividend growth rate for the next 10 years and then increasing it by 6% forever. And now you expect 9% on your expected return, right? Basically, what I'm saying is this is the price that you should be paying if you expect such return on your investment. So at this price, it sounds like a very good deal. On the other side, I don't think that Royal Bank is about to soar 60% in the next 12 or 2 years, right? 12 months or 2 years. What I really like doing with the dividend discount model is, imagine that I want to add a Canadian bank to my portfolio, but I'm not sure if I should add Royal Bank or TD Bank or Scotiabank. So let's say that I'm in between for the three of them. If I run the same calculation, so basically I just change the dividend payment right here, and I use the same dividend growth rate and same discount rate, I will get different valuation from each stocks. And I will look at the one that offers me the best potential return. So this doesn't mean that the stocks will surge, but if, for example, Scotiabank is showing me an expected return of 100%, because right now the intrinsic value is very low compared to the dividend growth profile, I might as well want to dig a little bit deeper in Scotiabank and leave TD and Royal Bank aside, because this will sound like a very good pick. Now, I just want to go back quickly for a second in terms of how to determine the dividend growth rate and where you can get that information, because I just shoot you a bunch of numbers. The best way to do it is either you pay for a service like YChart, like I do, or you go back right here in the investor relation of any banks or any company. So basically, if you want to have the information for Enbridge, you just type Enbridge investor relation, and then you're going to get here. You get into share information or stock information or dividend information, depending on how the website is built. Click on it, and then you'll have dividend history. So by clicking on dividend history, you will have the history of all the dividend paid per year for a very long time. So you will be able to do manual calculation and determine how much the company is increasing its dividend year after year. The second thing that you must look before determining if the company can increase it and keep that pace is to look at payout ratios. Then this would be covered in a completely other video, because we have a lot to talk about. But basically, if you have a high payout ratio, keep in mind that it will be very difficult for a company to keep up with a 6 or 7% dividend growth rate. And most of the time, what happens when the payout ratio starts rising, the management becomes a little bit more cautious about their increase, and it will just slow it down. So this was the example I want to show you. Now I'm going to go back to full screen. We're already at the end of this video, and I want to make sure to wrap up this whole thing about the dividend discount model and pretty much any kind of stock valuation methodology. First, keep in mind that those are based on academic studies. Those are based on principles, on theory, on like what it should be happening on the stock market. But keep in mind, it's not always the case. As I've demonstrated with the RBC example, I really don't think that RBC is going to surge 62% in the next 12 months. Thinking otherwise would be foolish. What you need to know is the real use of any stock valuation model is to give you an idea, a point of comparison for other peers in the same sector. It will be a tool to compare and determine which kind of stocks you want in your portfolio, but don't expect to have the value right. This will never happen, because down the road there are so many other factors that will influence the business and the stock price and the stock market that you will never for sure use any kind of stock valuation model that will tell you the right thing. However, using the dividend discount model is a great tool if you're a dividend growth investor. It will tell you how much you should pay for your printing machine, and basically it's going to give you a good start in your investing process. But keep in mind that when you select a very strong company, a leader in the market with strong growth vectors, with a nice dividend triangle, that is a lot more important than the price you pay, because down the road, in 20-25 years from now, the real bargain will have happened when you bought the stock today. So I hope that you have enjoyed this video, and make sure to subscribe to my YouTube channel, and in the meantime, stay invested.